Welcome to another episode of the Einstein Retirement Daily, where we curate financial, economic, and market news for the headlines that affect today's retiree. Having a little bit of tech issues here, and so we want to try and resolve that, and get this going for you. As always, if you hear something in today's podcast that causes you to want to take some action, make some changes, do something in your situation, this podcast should not be construed as specific tax, legal, or investment advice. If you want to take some action after the information you hear today, please confer with the appropriate tax, legal, or investment professional prior to making any changes. I just want to kind of monitor my speed here and also make sure that we're looking good and that you can hear me. If you happen to be on and watching, I see we have a few viewers. Type in a chat and see if this is any good. I'm sorry if it's not. But if you don't mind typing something in the chat, let me know that we're either good or it's too laggy and it's not going to work. Please let me know. Okay, we're going to talk about bonds. What should you invest in if you don't like the look of bonds? Who does? This article is sort of this podcast is inspired by an article from CNBC, and that article will be linked. The article is from Vicky McKeever, and Vicky highlights that, thank you, Maribel, appreciate that for letting me know that we're good. Thank you. So, interest rates are very low. Makes it hard to be a retiree right now. People need to be investing in safer types of investments as they get closer to retirement, because obviously you're in a position where you can't afford to be losing a lot of money, and so to earn some interest or growth in your investments in order for you to have a good retirement. But at the same time, interest rates are so low that it makes it very difficult to do that with traditional forms of fixed income. Things like bonds obviously are going to come to mind when we think about this. So if you don't want to invest in bonds, what should you be investing in? Okay, interest rates dropped again recently, and so that's the focus of the article from CNBC, and it's a common question that we run into. If I don't want to put my money in, say, a bond fund, because the bond fund is paying me, say, 1.5%, I mean, it wasn't that long ago that you could get 1.5% out of some CDs. Now we're talking about bonds that have some risk. And so you're going to try and invest in something that actually has some risk exposure and is still only paying you that 1.5%. Just a very difficult, tough position for us to be in when we're in that kind of environment where you're trying to get some returns out of your investments, but you also want to be safe, but there's no yield there. So what are some alternatives? You know, common alternatives are going to have some type of what we'll call a liquidity restriction, meaning if I don't want to invest in a bond fund, the alternatives to my bond funds that I might invest in are going to probably give me some restriction in terms of access to those funds. A very good and simple example of this is if I buy an intermediate term bond fund, I can sell that fund at any time with absolutely no problem whatsoever. Let's say that intermediate term bond fund pays me 1.4% in yield. Okay, that's my 30-day SEC yield out of that bond fund. Well, if I go and I purchase, say, a handful of individual bonds that all have maturities in that intermediate term time period, it's very likely, investment grade, that instead of only getting 1.4% or 1.5%, I could probably get closer to 2.5%. Maybe if I'm lucky, I might get something in that 2.7 kind of range. How am I going to earn so much more with individual bonds versus, say, a bond fund? Well, a bond fund has a problem, an ongoing problem. Bond funds are always required to realize what is known as a net asset value, and that must be reported on a daily basis. So essentially the fund has to assume in a mutual fund specifically, has to assume that you liquidate your shares of that fund immediately tomorrow. And so if you were to buy a bond mutual fund, you're going to pay the price, in a sense, for the movement in the interest rates and the interest rate risk that's affiliated with that immediately. So your bond funds are going to generally pay less than if you were to buy a basket of individual bonds that sort of matched your time horizon and your needs. Now, on the flip side, the bond fund, if you want your money back, you can simply sell that fund, and the mutual fund is required to redeem your shares and pay you whatever the current market value is, that net asset value. Whereas an individual bond, you actually have to have a buyer for your bond. So when you go out to sell your bonds, there has to be someone on the other side of the table, in a sense, that wants to purchase those bonds. So that can be a little tricky. You need to be making sure you have enough liquidity and access. Otherwise, you may end up selling your bonds for much less than what they are technically worth. You may own bonds that are worth more than what if you actually go to sell them, because you're selling them, say, with just one broker. And by broker, I mean like a Vanguard or a TD Ameritrade or a Schwab or a Fidelity. Those are your brokers. You may be selling it through one broker, and if they're not going out into the universe of bond buyers and saying, hey, we have this inventory, someone wants to sell these bonds, and in doing that, they're just selling them only at their one broker, there has to be someone else who uses, say you're using Fidelity, who also is using Fidelity to buy that bond. There has to be someone there willing to purchase it at the price that you want to sell it for. That probability goes lower, which means you probably can't sell them for as much as you're hoping for. Therefore, we would have what we would call reduced liquidity. Okay, it's not as easy to sell those bonds as it is a bond fund. So it's a reduction in liquidity. So we often see people turning to different types of investment options, things like fixed annuities. A really good example would be like let's go with a 5-year fixed annuity. Okay, I didn't run the rates today, but you can assume that a 5-year fixed annuity is going to pay you somewhere between 2.5% and 2.8%, somewhere in that range. Okay, that's as of today, which is August 17th of 2021, okay? So if you can get a fixed annuity paying on a 5-year, paying 2.5 to 2.8%, your bond, your investment grade bond, which is what you'd have to be to have similar risk level, okay? Investment grade bond, A-rated or better, because insurance companies offer true guarantees. And so to get that level of protection, you need to go to an A-rated bond. And a 5-year A-rated bond, even an individual bond, you're going to have a very tough time breaking 0.5%. Now, you might be able to get as much as 1% on something like that, but it's going to be tough. If you go to a bond fund that has, say, maturities mostly around that 3 to 5 year window, it's not going to happen. We're talking 0.5, 0.4%. I mean, very low rates. So that's where a fixed annuity can offer a reasonable alternative. So products like that can be very helpful. Sometimes people will turn to CDs, but you're going to see with your CDs rates more like bonds, because the bank is buying bonds to guarantee the CD, generally speaking, and the liquidity is there. Okay, so the liquidity on a CD is usually pretty good. You can usually get your money fairly quickly. And so if you try to sell your get rid of your CD, it's very much like a bond, except in some ways more liquid than a bond, because all they'll do is take back 6 months of interest on most CDs. So because the liquidity is there, your rates of return are going to be very similar. Now, some people will use investment options. Well, I shouldn't have said the word option, because that's the next word. They'll use strategies like options. So what they'll do is they'll buy, say, stocks that pay dividends. You could probably construct a reasonable dividend stock portfolio with yields in the neighborhood of 2 to 3%, somewhere in that range is probably pretty reasonable. And so what you can do then, that's not safe, that's stock investing. So what you could do is you could do simultaneously buy calls. No, I said that right the first time. Sell a call. Options is complex if you haven't figured this out. You sell the call, so you get revenue, which gives someone the right in the future to purchase your stocks at a given price. So you sell a call, you get some income, and then to protect your position, you can use that income from selling the call to simply buy a put, which allows you to force someone else to buy your position at a given price. And so you can protect your stock holdings by limiting your loss exposure by buying the put and potentially get a little extra income from selling a call. Now, if you sell a call and buy the put for the same price, then it's a wash. The real net income that you'll get is going to come all from that dividend income that you're getting. The one advantage with dividend income is so long as it's in a brokerage account, not an IRA or a Roth IRA, that dividend income is going to be taxed at long-term capital gains rates rather than ordinary income rates. So there's some tax advantages to that also. So those are three options there: switching to individual bonds, going to a fixed annuity, or switching over to some option strategies. That's another way to go. Now, the other more, I would say, gaining popularity strategy, and is gaining a lot of popularity very quickly, so much so that banks, brokers, and insurance companies all play in this space. And this type of investment is called a derivative. When you use derivatives, what you are doing is you are getting your returns based upon the performance of an underlying asset, okay? So you're not actually investing your money in the asset, you're getting your returns from the performance of that asset. So that's why it's called a derivative. Derivatives get their name because you're deriving your return from an underlying asset. To keep it simple, let's assume for a minute that you were to derive your returns from the performance of the S&P 500. But you were to have a guarantee, say from a bank with a structured CD, or a broker with a structured note, or an insurance company with a fixed indexed annuity. By having these sorts of derivatives, you get to earn performance based on the S&P 500, but the broker, bank, or insurance company is going to give you some kind of guarantee against losses. Okay, very commonly, fixed indexed annuities will give you a 100% guarantee against losses. The structured note could give you 100% guarantee against losses, or maybe they'll only protect, they won't protect the first 5 or 10%. So you could lose 5 to 10% or something like that, which means you probably earn more if the S&P 500 grows more, okay? So you can get some protection there. And then the structured CD, very similar to the fixed indexed annuity, whereas you could get complete guarantees on your against losses, or like the structured note where you could have just some protection against losses but not total protection. So these types of products allow you to earn your growth not from bonds, but have the same protection mechanisms that we want from bonds, where there's a limited amount of risk or even no risk, as in the case of structured derivative products that are guaranteed against losses. Okay, so these are the ways that people are investing dollars to avoid having to use these traditional strategies like bond funds, which leave so much to be desired these days with interest rates where they are. And so they're using these other types of products. The big thing that you have to understand is more growth, more protection equals less liquidity, less access to the money. Okay, everybody plays in the same sandbox. Okay, that's not magic. Everybody is playing in the same sandbox. If you want more growth, you're going to be less protected, or less liquidity, less access. if you have more, more liquidity, you're going to have less growth or less protection. Okay, you get one of the three. You never get all three at once. Okay, that's all we have for today. As always, we'll link the article in the the description section. There we go, description. So you can see what's going on with interest rates. Hope you found this to be helpful. As always, we look forward to seeing you at a future event if you'd like to join us for one of our live workshops. And with that, we'll wrap up for today.